Good morning, everyone. Good morning, David. Thanks for joining us.
Morning. Yeah, always a pleasure.
Excellent. I'm really looking forward to today's discussion. It's going to be jam-packed, so everybody, please pay attention. We're going to try and tackle this very big topic. For me, and maybe just also, I mean, it's great to host somebody like David. That's clearly very popular. We've got a huge number of people attending today, and a lot of them not from the Asset Map community. So I just want to say welcome to everyone. I mean, this community is really about focusing on what differentiates, or what's our true differentiation as financial planners. And of course, we think the only differentiation is in our client conversations. So so it's fantastic as we're all going on that sort of advice 3.0 or advice engagement journey, as we call it. All right. So let's kick us off. I want to introduce David, not that he needs any introduction. He's come up through the ranks, paraplanner, planner, at some point went into the big league, joined the FPI as both as director and then I think head of public policy. Is that right, David?
That's correct, Benny, yes.
Okay, that's excellent. And then of late, left the FPI and started FI Consult. Yeah, maybe just give us a high-level overview. How's that been? And yeah, what do you hope to achieve with that?
Yeah, so Benny, thank you very much. And it really was a combination of all my experience and deciding on what is my next evolution. And that's why we came up with FI Consult Business Evolution. And really what we are is we're a management consulting firm that consults to financial services providers on strategy, operations, and human engagement. So we use the term human engagement because that includes staff as well as client engagement practices. And a lot of people ask us why the name FI Consult or Financial Institution Consult. And quite simply is because we know that the term FSP or financial services providers is on the way out. So it's to demonstrate the fact that we are future thinking. So even before CoFI has been proclamated and the term financial institution becomes widely used, we were there first. So that's
I love it. I thought that was such a clever thing. I think you're gonna get a lot of free marketing in the not too distant future. So well 100%. Done on that, yeah, and all the best for that venture. I know you guys are really busy, so I appreciate that you're spending the time with us today.
No, it's always a big pleasure.
So now, just to set the scene for everybody on the call, CoFI has been around, feels like forever, and not happening. And we read these articles where people talk about CoFI is phase on steroids, and then we sort of panic, and I go and read up the legislation, and then I forget about it again. And so really today, because it feels like we're getting close to implementation, the focus really today is at a very high level to get our minds around what is CoFI. And as business owners, what do we need to do to get the most to make the most of this opportunity? So that's what we want to focus on. So maybe just David, please just remind us, like what is the sort of the context, like CoFI feels, I'm not even sure when it started, but if you can just give us a quick overview of the roadmap.
Yeah, sure, Betty. So the reality is CoFI started almost 16 years ago now. That's how long it's been. And why do I say 16 years? Well, it was really the 2008 global financial crisis that really put impetus to this environment that we're operating in. And although our regulator and legislators were looking at market conduct way before then, I mean, some of the milestones that we can look at is things like the statement of intent between long-term insurers and the Trevor Manuel, the then Minister of Finance, which was signed in 2005, which really was around surrender penalties on policies, which then eventually became legislation. In 2008, we had the Banking Industries Competition Commission Tribunal, which they looked at practices and poor outcomes from that viewpoint. In 2007, and 2010, we had Fidentia and ShareMax scandals hitting us. So, yeah, even though we had phase implemented in 2004, and you and I were talking before this, that's 20 years ago. And 2004 for me seems like it was, yeah, that was last year, wasn't it? But it was 20 years ago that the major piece of legislation came in. So we are probably due a change. And the reality is what they're really looking at is saying, despite all the laws and the regulations that are in place, we're still seeing poor client outcomes. So CoFI's approach is to move away from this rules-based approach to a more of an outcomes-based approach. Now, the Twin Peaks, the so-called Twin Peaks model, where we're moving away from having sectorial regulators to a regulator for prudential matters and a regulator for market conduct matters, was actually first tabled in 2011 in Parliament. Okay, so that's when they agreed to move to Twin Peaks. We then saw a discussion document coming out in 2014, so that's 10 years ago, which was entitled Treating Customers Fairly in the Financial Sector, a Draft Market Conduct Framework. That led to November 2017, which was the release of the then FSB's Retail Distribution Review, the discussion documents and proposals. And we've really been on a process of regulatory reform, over those 10 odd years. Now, the Conduct of Financial Institutions Act is the last piece of legislation that we are looking at that's going to implement some of the final recommendations in RDR. And I say some of the final because a lot of them have already been implemented through the current regulatory environment. So that's a brief history lesson on where we got to where we are.
So it's been coming along for a long time. Why should we pay attention now? Is like, how close are we to actually getting going on it?
Well, to put my neck on the block, because I've been talking about this every time I did a budget analysis over the last 3 years, I immediately went to the financial services sector part of it. And in that, the minister said, CoFI is going to be in Parliament this year. Okay, so that's been for the last 3 years, except for this budget speech where he didn't actually mention CoFI. So the thinking was, will we actually see it this year? And the major thought process was, we're not going to see it this year because we're dealing with things like grey listing, and that shifted the focus away from everything else. But at the recent FSCA industry conference, there was again talk that this year CoFI will actually hit Parliament. So when it hits Parliament, it's still got to go through a process of Parliament approving things. I think if I can say, if we look at the Financial Sector Regulation Act, which was actually the act that established the Prudential Authority and the Market Conduct Authority. That was first tabled in Parliament in 2013, and it was finally signed into law in 2017. Okay, so I'm not going to put my hand on the block and say CoFI is coming in 2025 or even 2024, but it is imminent. We are going to see it coming through quickly. I know as well that both National Treasury and the FSCA have been working hard behind the scenes to make sure that once CoFI is in, the work that is needed is going to be fast-tracked. Okay, and what I mean by that, when you read CoFI, it's a very funny bill for me because it's a bill of very little substance, in my opinion. And what I mean by that, it's really an enabling piece of legislation. So yes, it gives you very high-level principles, but the detail is going to come in something called conduct standards. And those conduct standards is really what's going to allow us to see what the implementation of CoFI really looks like in our practices and our businesses.
All right, so I think just to wake everybody up, in case people were starting to nod off because of all this legislation, because there are 3 areas that is not fuzzy in CoFI that it wants to impact directly in practices. The one is our processes, and I think that's where we want to focus today. Like, so in other words, the legislation talks about the processes in your practice, and then just quickly 2 other areas that we're not going to talk about today, but it's important that we start thinking about it. The one is on capital adequacy. So just like for large insurers and asset managers, there are going to be probably more stringent capital requirements for financial planning practice. So that means the people on the call, they're going to have to leave money in their bank account in the practice, and maybe substantial amounts. And so that's definitely something to start thinking about in your practice. how is that going to be funded? Who's going to fund it, etc. And then the second aspect is transformation. There's going to be definite transformation targets, and that stuff doesn't happen overnight. So we need to think about that. So maybe just any idea. Again, not putting your head on the block, but just is that like, when is that likely to come into play?
Yeah, so let's deal with the transformation one, because we've got a lot more information around that at this point, because the FSCA has actually released 2 discussions around transformation. Again, the first one saying that it's got to be approached in 2 phases. And the reality is the state of transformation is not very well known. I mean, transformation data is not something that has been gathered very well. We have a BEE code for financial services. So there is the Financial Sector Transformation Council. So we've got our own BEE code for financial services. I also think, though, particularly your small and medium enterprises have largely ignored it. Why? Because that code was put together by the large companies. It was put together by the large insurers, the banks. So everyone thought that only applied to them. The reality is it applies to everyone in financial services. Now, the high level thinking is that from a licensing viewpoint, you are going to have to be BEE compliant. What that looks like, we're not really sure. The idea being bantered around at the moment is that you've got to be triple BEE compliant at least at a level 4, okay, which for small enterprises, which is enterprises with a turnover under 10 million rand, it's an affidavit. Okay, between 10 to 50 million rand, you've got to go through the scorecard and match yourself against that. So if we're talking about preparation for that, the idea would be to get hold of the scorecard, and not the general BEE scorecard, but the scorecard from the Financial Sector Transformation Authority. And from there, actually start analyzing yourself against that and see if you meet the requirements to be BEE level 4. There is still a lot of debate going on around that. And I know while I was at the FBI, some of the commentary we made is that one of the key things about the CoFI environment is proportionality. Okay, so that's a word that's been used quite a lot. And particularly from the BEE point of view, we need to consider that financial planning businesses are different from a life insurance or a listed entity. Okay, and particularly when it comes to things like ownership structures. Okay, ownership structures are very easy to look at from a listed entity viewpoint. From an owner-managed business, it becomes a lot more complicated. And the reality is, when we look at how the wealth is distributed in a financial planning business, the owner doesn't get most of the wealth. Most of the wealth goes to the advisors who are actually advising the client. So is there not space to start talking about advisor development and advisor growth? Because that is really true economic transformation and uplifting of people, because we're also then getting to a viewpoint of financial inclusion, which is also very important. So the more diversity we have in our advisor base from an age, gender, and a race viewpoint, the more South Africans can actually connect with financial advisors who look like them, the better it's going to be for financial inclusion. So that's my long way of saying there's still a lot about a debate about it, but what you can do in the meantime is start analyzing where you fit in terms of the financial sector BEE scoring.
And just on the capital side, I mean, again, just hopefully it's not going to be a surprise sprung on us.
No, again, I think if you're meeting the capital requirements in terms of phase, I don't think it's going to be more than that. And again, I'm basing my opinion based on the proportionality side. And yeah, we've also got to consider the risk-based approach that they're looking at. Now, I mean, I mentioned the Fidentia scandal because that was actually mentioned in the accompanying policy paper to CoFI. And the reality is that if I was a financial advisor who put clients' money in Fidentia and something happened to me as a financial advisor, it wouldn't have affected my client's money as much. So from a risk-based approach, the advice, yes, getting to the point of recommending a product provider is very risky. But once that advice has been implemented, financial advisors generally are not the ones holding the client's money. So we are at a lower risk of if something goes wrong in terms of the business folding, because the client's money is still protected being in a third party. So advice is probably the most valuable part of it, but the least risky in the value chain. So I'm hoping that the proportionality principle will be applied. And yes, we don't want to see advisors who are insolvent or struggling financially, because that increases the risk. But I do think it might not be worse than what we've got at the moment.
Yeah. Well, it's definitely worth keeping an eye on, so that we don't suddenly get a huge
Yeah,
pour on
100%.
our cash resources. All right, well, let's get into the meat of it. So we know there's other stuff that changes CoFI. There's going to be new terminology. There's going to be new reporting. But we're going to not focus on that stuff today. So that I think because CoFI represents probably a massive mindset change for us, I want to just quickly start off by talking about mindset. And I was fortunate or unfortunate enough, when phase came in, I think I might have been in my late 20s still. And I remember presenting to our board of directors about this new legislation, and it's so onerous, and we have to do this and that. And our chairperson was a very outspoken public figure. I mean, most people on the call would know him. And he just called me out straight out. He said, "Benny, your attitude is wrong." Geez, so I had like such a fright. I thought I was going to be fired. Anyway, and he said to me, "Benny, why do cars have ABS brakes?" And like I said, I don't know, like to make them stop. And he goes like, no, that's what everybody says. Cars have got ABS modern brakes to go faster. Because we know we can rely on our brakes, we can go faster. And by extension, if you think about a race car, I mean, you'd never go racing if you don't have excellent brakes. And so legislation is our brakes, and which means that we can push the boundaries, we can go faster, we can, we can be commercially be more successful because we know we can rely on our strong brakes. So that analogy always stuck with me when I think about legislation. It's our safety, it's our brakes. And I think that's an important lesson, that we don't go into a massive change like this with a mindset of like it's onerous and negative. This is going to empower our businesses. How do you think about approaching a big change like this, David?
So Benny, I agree with you 100%. And forgive me, but I'm going to read because I don't want to get this wrong. And this for me, the policy paper is quite a big read. But this for me is the paragraph that really should settle our mindset when it comes to the new regulatory regime. And this is the paragraph. It says, "A narrow focus on rigid rules and compliance reporting has often led to the letter of the law being followed, while the spirit of the law is missed. A principle-based approach seeks to set principles that specify the intention of the regulation rather than set rules detailing requirements of a financial institution. A focus on principles should see a shift in both industry and the regulator towards ensuring that their actions and processes," okay, there's your processes, "are geared towards driving the attainment of certain desired outcomes in the financial sector, not only to technical compliance with the law." Okay. So if nothing else, that is the most important paragraph for us to think about. Okay. So what does this mean? Okay. Now, firstly, I just want to be clear. It doesn't mean that we're going to see all the rules chucked out the window and we're going to go back to the Wild West days before phase. There will be some rules. We cannot have regulation without some rules. But the overriding approach of this regulation is that the rules of the playground are going to be set. Okay, but how we operate within that playground is going to be up to every single business. Okay, and every single business is going to have to look at it and go, why do we have the rules in place? So your analogy is perfect. Why do we have ABS brakes? Well, because cars are going faster now. Because cars are going faster, we need a better way to stop them. Yeah. So once I understand the rules and the framework in which I'm allowed to operate, it is up to me as my business to go, how am I going to implement these principles? And how am I going to do this that it makes sense from a commercial viewpoint? Years ago, I saw a cartoon, and this is what stuck with me. The mindset shift that we got to be doing is compliance by the client, not compliance by the book. Okay. And what do I mean by that? It is no longer going to be good enough to say, but hey, I put this disclosure document or this piece of paper and the client signed the piece of paper. We're going to have to demonstrate that through our conversations, through our processes, these are the expectations that we created in the client's mind, and this is how we are meeting those expectations. And as long as you can demonstrate that, I think you're going to be okay. Now, what makes it really exciting is that creates opportunity.
Absolutely. And we're going to get to that. But I want to just pause 1 second and just make this crystal clear for everybody. The shift from like a rules-based to outcomes-based, or letter of the law to spirit of the law, is a massive shift. In the past, when it was rules-based, what would we do? What could we do? We just send a piece of legislation to our compliance officer and say, what do I need to do? With CoFI, if we do that and we send it to the compliance officer and say, what do I need to do? The compliance officer will come back and go like, I don't know. The legislation doesn't tell me what tick boxes I need to do. So there's going to be no or very few or much fewer tick boxes with the new legislation. So I think that is a massive mindset. We're going to have to think about it from a business perspective and from there figure out the compliance, not the other way around. So that feels like a major shift to me, and I think it's going to take a different mindset and a completely different approach. Now,
Benny, I agree with you. I'm just going to jump in and give you a practical example of that approach already, because we've seen that in some of the legislation that has already been coming in. And the example I use is the introduction of continuous professional development. Okay. So what was introduced with that is we had a rule that says based on your license category, you need to do 6, 12, or 18 hours worth of CPD. That was it. That was the rule. Okay. What those 18 hours looked like was left up to the FSP to put a policy in place, to put personal development plans in place, and decide for each individual advisor what their CPD needs to look like. Okay. So for instance, if you were working strongly in the investment space, you might have tailored your CPD to be more around investments. If you found that you were lacking in your use of systems and administration, you might have tailored CPD to be on that side of things. But that was up to the FSP to decide what is the right approach for us and how are we going to adopt this, knowing that the only thing I needed to meet is that there were 18 hours and it was relevant to the role of the person. So that's one example of principle-based with some rules.
I love it. And it means that we've got to really think about our practices. Yeah, exactly. Okay, so that feels like the first principle is there's going to be no checklist.
Yeah.
The second leg of this thing, and I think this is where we're going to spend a bit of time, is okay, so what is the spirit of the law? In other words, if there's not going to be a rules, what are we aiming for? What is the legislation aiming for? What is the outcome that the legislation is asking us to meet?
So again, I'm going to use a practical example, and this is something I've been probably talking about for about 4 years now. So it's in one of my keynotes that I deliver, which is compliance by the client. And I jumped on the disclosure letter, okay, and really thinking about why do we have a disclosure letter in the first place, okay. So in my research, I Googled phase disclosure letter, and I got somewhere between 200 and 300,000 hits on that. And I probably downloaded a sample of about 50 disclosure letters just to read through and see what is different in them. And the reality is there was a slight variation, and there were probably about 3 variations. Okay, so my mind says that's probably because there were 3 main templates that everyone was using, and those 3 templates was what was implemented by probably 90% of the businesses out there. And invariably, every one of them started along the lines of, in terms of the phase acts, or as required by the phase legislation, or because I'm required by the phase law, I want to disclose these things to you. Now, if we take a step back and think about why the regulator actually wants us to disclose things, and it's very clear what their intention is behind the disclosure. The intention is to make sure that the consumer, okay, and they refer to them as customers. I refer to them as clients because we're professional services. But it's really knowing the client being able to make an informed decision about you and knowing who is responsible for giving the advice. Okay. Because there was a lot of things, and a lot of the share max and the blue zone and the property syndication resulted because there was very untransparent information about who was actually delivering the advice and who was responsible. So if we understand that disclosure is about putting a client in an informed decision, my recommendation is that we change the introduction to our disclosure letter. Okay. So instead of saying as compelled to by the law, why don't we say, in order for you to make an informed decision whether we're the right business for you to work with, we would like to give information to you. This does two things. Okay. Number one, it gives the client the impression that you're open and transparent, because my mind works slightly different to somebody else. Okay. And it is a viewpoint of saying, if you came to me and said, because the law requires me, I'm telling you this, my immediate thought process is, okay, so you wouldn't tell me this if the law didn't ask you to. So you would hide it away from me. Whereas if you go and you say, we want to be open and transparent so you can make a right decision. Secondly, it changes your disclosure document from a compliance document to a marketing document. And that's where we've missed an opportunity. Okay. I'm not disclosing things to clients because the law tells me to. I'm using that as a framework and a checklist to say, am I getting to get into trouble if I miss something out? So I want to include this information. Or am I using what the law is requiring me to say to promote myself and make clients fall in love with me and build that trust in the first meeting? And that's really what the advantage and the opportunity that I think we missed with Phase that we can now utilize in a CoFI world.
I mean, that's a wonderful example. And I think it's not like, if we want to use the opportunity, I think CoFI is going to force us to do that. And for everyone, David has been kind enough to give us a template of what, and we'll share that with everyone afterwards. Share, what could an engagement letter be, or what it could look like in this new CoFI world, bearing in mind it's going to be different for every practice, but there's an outline to prompt some thoughts. And so that's the fascinating thing for me, David, about this legislation. And now I'm going to read because that I make sure I get it right. But it's this thing about that the intention of the legislation is improved client outcomes by improved conduct by the financial advisors.
Yep.
And so that's what we need to get to, is improved client outcomes by the way we engage, by the way we run our businesses and engage with clients. And so I'm going to just pause for a second on that, like improved client outcomes, because I mean, it's not clearly described. So one could maybe take a narrow, different think and say, listen, when I implement a financial transaction, I need to fill in the forms but one could also say, a better client outcome is if the client should have done something, I should have recommended something, and client didn't pitch for the review, or we did the review and we just focused anyway. And so this client improving client outcomes, it feels relative, it feels fuzzy, and I think it's different in different practices. So yeah, just your thoughts on, like, what would that mean for different practices improving client outcomes?
Yeah. So let me put it this way. If I said to you, you could have a perfect compliant file, but still have poor outcomes for clients, would you believe me? Okay. And that's the rub of what it is, and again, I'm going to utilize something to say that we've got a suitability standard. Okay. So a lot of the legislation talks about a suitable product, and the product must be suitable. So looking at the suitability standard, if I've got a client who's putting something together for retirement, and I recommend a retirement annuity, okay, we both know that we've got two types of products. We've got a life insurance-based product, and we've got a unit trust-based retirement annuity product. Now, And again, I'm going to generalize here a bit, but don't take this as a rule, because there are places for all types of products. But in general, clients would be better served and better off in a unit trust-based product, because there's no lock-in periods, there's no penalties, and the costs are generally lower. But from a suitability analysis, both would actually be suitable for the client. The one, however, I can get paid up front, and the other one I get paid off over time through trail commissions or assets under management. So from a pure suitability standard viewpoint, the client could be recommended either product. Okay? And I could probably be compliant showing why I chose one over the other. But if I put my client's outcome hat on, I'm probably better off. And again, please, I'm using probably and maybe, because we know that financial planning is individual and I don't want everyone to suddenly switch. But it might be better off being in one product over the other. But I make the decision based on what's good for me, not necessarily the client outcome. 100% compliant, but the client outcome is worse off. So that's what the fundamental shift is going to be. I think we're moving away from a viewpoint of saying, but the client signed. And again, I've read a lot of ombudsman cases which say, well, but the client signed for this. The client signed the quote. The client agreed to this. But there's a lack of demonstration of understanding. And one of the other big things that we're trying to get rid of is what they call the asymmetry of information between the consumer and the industry. We know a lot more. Okay, we are very clear in terms of how these products work. It's very confusing for the end consumer out there how these products work. And I do believe this is where one of the major values of the financial advisory process is, and why I still believed that clients in an advice capacity are better off than clients buying directly, because that asymmetry of information, I know at the time when robo-advice came out and Betterment was like, you can be, from sitting down to invested, it can take 5 minutes. The reality is the transfer of knowledge and the education is not taking place in that process. Okay, so for an unsophisticated client who looked at an advert and thought this might be good for me, they're missing out on the biggest value, which is the advice about what is right for you. Okay, so advice for me is the most valuable thing. The product is a secondary value that comes after that.
Absolutely, but I push you on that. It's more specific than that. Like, what is the value of advice? And I think that is where, I mean, for me, that's probably the biggest thing. And we deal with many hundreds of different practices. And it's always fascinating to me that every single practice expresses their value differently. They've got their own unique approach, their own unique client. It's a combination of the planner, the practices as individuals. What do they believe? And also their client segments and their service models. And so I think this thing about improving client outcomes, it's going to be something that practices really grapple with. In my practice, what is important, what do I believe is important to improve client outcomes? And it's not going to be fuzzy. We can't make it like fuzzy, like, oh, it's like it's actually say, oh, they signed the documents and we've got a full file and stuff. That's not improving client outcomes. We're going to really have to look deep in ourselves and go, what do we believe improve client outcomes? And of course, and we're going to work through examples now, so that people can start getting used to this idea of what do I believe results in better client outcomes.
And Benny, I think the reality is, if we look at it, and Morningstar did a study, it's probably a good 3 or 4 years ago, where they asked the question, what is valuable? And they asked advisors and they asked clients. Okay, and there was a big mismatch between what advisors thought was valuable and what clients thought was valuable. And the number one mismatch, where clients saw value and advisors thought they weren't adding value, was the returns that are generated for us by our advisors. So clients rated that highly and advisors didn't. The other one was where advisors rated it highly, which was around the behavioral aspects and the conversations we have around money. They thought that was value adding. The clients didn't see the value in it. Now, the question arises, why? Okay. And this is again where, as insiders, we know where financial planning has gone. We know that the value has shifted from being technically competent and choosing great products Still valuable, okay, still adds to what we can do. But the value has changed from the product side to the advice side, which is around the behavioral aspects. It's around being an accountability partner. It's around making sure that the priorities and the choices and the values are managed and adhered to. So why do clients still believe that it's the value we add? And I think that comes down to our review process. Okay. And again, it's because we implemented a compliant review process. Now, what do I mean by that? Well, the law says that on a regular basis, at least annually, you have to give the client certain information. So our review processes were built around the information that we have to give the client, which is often about what their responsibilities are, the performances, et cetera, et cetera. The reality is when we do that and we have a review process which starts off by doing an economic review and telling clients how well the investments have performed, hopefully, or coming in and telling clients how badly they've performed, but yeah, in terms of the market and the conditions, you've actually performed very well. We are training our clients to believe that the value we add is the return that we generate for them. If we change our review process and take away the discussion around returns to focus it on that last year when we met, we set certain goals in place. How are you tracking towards that goal that you implemented? Okay, and the example I use is you meet with a client and he says, look, when I got married, I couldn't afford to take my wife on a honeymoon. So I want to plan for our 10th anniversary. I want to take my wife to Paris and show her the city of love. Okay. Next year we go, okay, you've got 9 years left of your goal. How are you tracking towards this? Are you still okay to go to Paris? Or do we have to modify your goal that you're going to Paris? Okay. And again, nothing against Paris, but yeah, it's not Paris. If you're on track with your goal, surely your review process needs to stop there. You don't need to go into the performance because everything is on track and you're meeting your goal. If you're off track with your goal, that's where you need to have different discussions. Okay, why are you off track? Well, remember, there were 2 wars that started. This affected the markets negatively. What is our outcome? Then you can start having those discussions about how to get back on track. It might even be a case of that the client went through COVID and their income reduced by 50%, and therefore they had to stop their plan. So now the discussion is, how do we get you back on track with your plan? It's a different review process than just giving feedback. The information that is required in terms of phase, we can do that differently. Okay, you can send the client a video update once a quarter if you want to. You can send the client a written statement once a month. Okay, you're meeting your objective in terms of telling them what you need to have, but make the time that you spend in front of the client value adding for them rather than just a report back process.
Mm-hmm. I mean, Gary sent us a question here. I think it's only us that can see it, but I mean, Gary hit the nail on the head. You know, I mean, and I mean, it's so interesting to hear how he expresses, you know, value, and so his point was the record of advice is only relevant at the time of the advice.
Yeah.
Okay. And in other words, as soon as the client walks out, things change, the client's circumstances change, products change, and he also reminded us clients' memories aren't always the best when suddenly things go wrong and stuff. And so just think about like expressing that as a value statement to your clients. You know, things change, things happen. The value that I'm adding is X, Y, Z. So I think, David, I mean, that's an awesome example. But what I'm trying to get, and maybe David has been coy here because he's got the secret sauce here. I think for most people, they can sort of try and work out for their practice, how do they improve client outcomes? They sort of know, you know, this is what we do. And yes, maybe we don't do it as consistently as we can, and we can improve the consistency and or differentiate service models a bit better or something. But we sort of have an idea of how we can improve our client outcomes. The challenge is between that theory, like improving client outcomes, how does that translate into, like, how do we get from that conceptual area to like practice and like how do we build that? Like, what is the bridge that builds it? And I'm going to use a completely arbitrary example now, but I want you to describe that process. For example, I want to know, does the fact that I send out a newsletter, because I think a lot of us just send out monthly newsletters, do I need to rethink that process? In other words, is that a helpful process? But how do I get from client outcomes to a very specific process? So what do you guys recommend?
Okay, so again, I'm going to give the general overview for it because, yeah, again, the question can be how long is a piece of string, and the reality is what is a good client outcome, okay? And it's a subjective discussion. It's a good client outcome is not something that I can put my finger on and say it's there. So the question is, because I remember early on I asked one of these questions. So if somebody else decides the client outcome, I'm at total risk because I can never control that. The reality, the control comes in setting the expectations. So what is it that you are promising? So this comes down to what your value proposition looks like, how you work, and what are you going to deliver to them. So if your value proposition is, we guarantee you that we're going to get the return that you want, okay, how are you implementing that? And what structures have you put in place to get the return? Understand, however, that if that is your value proposition, what of that value proposition is in your control? Okay. I can't control what the markets do. I can't control the decisions that asset managers make. Okay. Maybe to a certain degree where I know what their mandate is and they make it in a framework, but I'm very much not in control of the return that's going to be delivered to a client because there's so many variables after that. Whatever I can control is I can control and say to the client that I'm going to help you set a goal, track towards that goal, and make sure that everything in your power and my power to achieve that goal is going to be done. Okay, so I'm going to use my knowledge to make sure that you are structured correctly from a tax viewpoint. I'm going to use my knowledge to make sure that we scan the market for the best product that is out there for you from a cost and a suitability viewpoint. So those are things that you can control. So very importantly, the process is make sure that your value proposition sets the right expectations. Have a service level agreement in place with your clients. So make sure that you document what you are going to do, what their responsibilities are, what those responsibilities are, and then make sure you deliver on that. Okay, so if you say to a client, look, I'm going to send you a monthly newsletter as part of the value proposition, make sure that you send a monthly newsletter. And again, to answer your question, relook at what the value of that newsletter is. Okay, and the term that we use is constant relevant communication. Okay. So the question you've got to ask yourself is, am I doing a newsletter and building a newsletter that has got fantastic information in, and I'm sending that to my entire client base? Ask yourself, if you do a newsletter with 5 articles in, are those 5 articles relevant to every single person in your client base? Okay. If they're not, can you not do a differentiated letter and do a newsletter based on your client segments? Okay. And this could be a client segment from a viewpoint of what services they're using for you for. So if you've got clients who are only using you for investment services, don't send them something from a risk-based viewpoint unless it's a marketing pitch to try and grow their share of wallet with you. Okay, send them information that is relevant to them. So it starts becoming about, I've got my goals as a business. I understand my clients' needs, so I'm going to deliver to those clients' needs. And if I'm going to do a generic newsletter, is that applying to the goals of my business?
I mean, my mind just goes because I'm thinking it's such an innocent example. Like
Yeah.
what you said is like, what if I promise my clients I'm going to keep them informed?
Yeah.
Like I mean, that's going to improve client outcomes because I'm going to keep my clients informed. And then exactly because we haven't thought it through, then suddenly like, do we send the same newsletter to our older clients and younger clients? I mean, for me, that this is fascinating because I think we're going to trip ourselves up by putting like statements out there that we actually can't deliver. Even, I mean, it sounds like we can deliver it, but it's not, like keeping people informed. And so I think that is a great example to say how we can easily get this thing wrong, and yeah. So thanks for that example, because for me, that is, it just highlight immediately the risks here and the opportunities. Because if we can be very precise around what is our client promise, what is the promise to our clients, we can then take that. So what I'm hearing from you, David, is that you've got to really think about what is my promise to clients, and then break it down into principles or something. So I want to keep my clients informed, or I want to be forward looking. That's another thing. And then if I'm forward looking, well, which process? And then you really have to go through all your processes, because remember, when the FSCA comes in into your practice, they're not just going to say what went wrong with the specific client. They're going to say, show me your processes that delivered this promise to the client. So we're going to have to demonstrate that processes. So that's
demonstrate is very clear. I still want to make comments on Gary's comments about the record of advice. Okay, and this is another comment. A financial plan is useless, and it's probably not the right audience to say it in, but hear me out. But the process of planning is extremely valuable. Okay, and what do I mean by that? Okay, when we draft a financial plan, it is based on a snapshot of the time that we are giving the advice. Okay, the next day, those assumptions could change. Okay, we know that. I mean, I could base it on a certain inflation figure. The next day, we could be hit with something that drives inflation figure rightly up. So all my assumptions are out the window. Okay, and that's why a financial plan is not a once-off event. It's not a document you do once in your life and then it goes away. That's why we constantly need to review it, constantly need to be talking about it. But the process of getting to the plan, so the work that we do to get to the plan, is very important. And that's why we also need to change our mind about the record of advice. And what's happened is we've got, I think it's clause 9, I'm not very good with the clauses of the General Code of Conduct, that is headlined record of advice. And it tells you what needs to be in a record of advice. So what do? As an industry, we went and drew up a document that says record of advice. Okay. And that's what we give to the client and sign off. The reality is that document is a summary of the advice. It's not your record of advice. Okay. Your record of advice is so much more, because we cannot, in a 2-page document, detail 30 hours of meetings and conversations that we've had with clients to get to. So this is where your processes are also vitally important. And I think it's become a lot easier with technology, because you now have a Zoom call, you record the Zoom call. I've even seen in this that some people have that AI thing, which is automatically making transcripts and notes. Okay. So there's no doubt about who said what, and the memory doesn't have to happen because it's on record. It's there. That minutes of your meeting, that recording of the meeting with the client, is actually part of your record of advice. Okay? So your record of advice is made up of everything that you do to get to a point where you then summarize everything and send it to the client from a summary viewpoint. So the question is, in your process, how have you put all these things together?
Okay. Listen, we out of time, so I want to just try and wrap it up and try and succinctly summarize what we've covered today. So David, help me here, but it feels to me, what we're saying is CoFI is a step change from phase for 2 reasons. One is there's not going to be a tick box approach anymore. It's going to say we have to comply with the spirit of the legislation. And then the second major step is to say that the outcome is improved client outcomes by improving our conduct and processes. And so that feels to me like the massive mindset change that we need to make. And in order to do that, we need to unpack what our client promise is, what is our value proposition to clients, and then translate that into an actionable, is something we can build process and build and design processes around. Yeah, just maybe your take on it.
Yeah, I think that's a brilliant summary, Benny. It's about your understanding what my value proposition is and what promise am I making to clients. Okay? Making sure that I deliver on that promise. But again, making sure the playground and the boundaries that I'm allowed to do that in. Okay? So I understand the framework. I understand what the legislation requires of me. It's no longer a case of reading the legislation and saying, okay, how do I implement this so that I don't get into trouble? Okay. Yes, that's part of it. Okay. We don't want to do anything that's going to land us in the hot water, but it's how do I implement this so that it improves my business? So the big change now and what's available is instead of doing things by the book and instead of doing things because the law tells me to, it's a case of saying, how does what they're asking me to do make sense to my business? And how can I implement this in my business processes so that it grows, so that it scales my business rather than merely doing something because I need to comply with it?
Yeah, so I can just see this is going to be a minefield, because we're going to trip ourselves up by when we define our client promise. We're going to paint ourselves into a corner if we don't really think this through very carefully. And of course, that's why we've got experts like David. So thank you very much, David. I know you do a fantastic job. FI Consult has got processes or what do you call it, workshops or ways to work with practices to really understand this stuff and figure out. And I've seen some of the output. You're going to see it in that template that we're going to share with you. I mean, the outcomes are amazing. And so I think that is the promise of CoFI, that if we really get on top of these things, we can be miles ahead or keep miles ahead, you know, of the competition.
Yeah, and Benny, just as a final thought, I know that there is still some uncertainty because we haven't seen the conduct standards. But we generally know where this is going and what's going to happen with it. So my quest to people is don't wait until we see the first draft of the conduct standards, because then by then it's already too late. Okay. Start looking at your business, start looking at what you can do now and implement things. And I promise you, if you approach it from the client viewpoint, if you approach it from your business viewpoint, you're not going to do anything that you're going to have to redo somewhere down the line. Okay. It is something that maybe you need to tweak a little bit, but you are going to have the foundation and the base there.
Excellent. Listen, we could talk about this stuff for another
Indeed
hour or three. So David, I really appreciate your time. We're going to share David's contact details and the template. So thank you very much for everybody's time, and good luck. I mean, this feels like it's a major step up for the industry, and it's a great opportunity just to rethink what we do and think about it afresh.